Today, the establishment's new attempts to escape blame for economic Armageddon. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. And this is an emergency post because there's been some significant events today. And I'm joined by Economist John Adams. Hello, John.
Hello, sir.
So we're going to talk about the interest-only loan thing and the we could increase lending no problem thing.
Yes. Like it would appear that the financial establishment in this country, with the Reserve Bank and APRA, they've made some significant moves today to help get the bubble going. So obviously there's concern about particularly Sydney house prices falling, and so there's been a few new manoeuvres to try to shore up the property market and to get people more in debt.
Yeah, and this is what I've been calling unnatural acts. Now, you could argue they're actually natural acts because it's typical that the regulatory guys will be driving it this particular way. But from my perspective, bearing in mind the debt bomb that we've got, it's completely a set of unnatural acts.
Yes. So I was going to say yes. So I woke up this morning and I was reading, I looked at the Australian, and then I was surprised. There was an article about the Reserve Bank. The Reserve Bank governor in the last, I think, week has met the chief executives of the big four banks and has expressed the Reserve Bank's concern about tight credit standards, and that in the governor's view, people who should qualify for a loan are not getting a loan, and the risk appetite in the banks are too conservative. And basically, he needs the banks to start obviously loosening the sort of approval process up, and to get more debt and get more loans approved.
Yeah, so I saw that as well, and I'm thinking, so what they're actually saying implicitly is the criminal behaviour that was identified in the Royal Commission over the last few months was actually okay. That's the implication, isn't it? Because what they're saying is that the lending is now too tight and it needs to be loosened up.
Yes, yeah. So like a few people on Twitter made that point to say effectively the Reserve Bank is asking the banks to engage in further criminal acts by not following the law and providing loans. But the Reserve Bank is not looking at it from a point of law. It's looking at it from a point of economics. And the bubble is so big that they need to keep it intact. And they're very nervous that if they lose control, it will sort of there'll be there'll be blowback on the RBA plus on the government and the banks and the real economy.
And that's really the point, and that's what we want to get to today, isn't there? The underlying reasons why this is actually going on, right?
Yep.
That's the critical point.
Yes. So I thought it'd be good that if we just quote the Australian article just to give context about what the Reserve Bank did. So this is from the Australian this morning. The quote is, the Reserve Bank Governor Philip Lowe is understood to have met the big four bank chiefs in recent weeks to caution them against an overzealous tightening of credit supply in response to lending rules and the Hayne Royal Commission. A key message conveyed was that while prudent lending was the aspiration, the banks were in some instances turning away good loans or not taking enough risk to warrant even a small tick up in arrears, senior sources at the big four banks said. The meetings were conducted separately with each of the banks. So obviously the RBA is in full panic mode, particularly because we're seeing a deflation in terms of property prices, and so basically they're trying to shore up the market. But in this two paragraph from the Australian, what I thought was so significant was that prudent lending is an aspiration. Well, prudent lending should be the norm. It should be the practice. Yeah. The fact that I'm interested to know, is the Australian effectively putting words in the mouth of the RBA, or is this the RBA line? Prudent lending is an aspiration, but we need to actually be doing something else.
Mm-hmm. It really does, put a bunch of questions, not least because, of course, responsible lending, which has really been the focus of the Royal Commission, right, has really underscored that you have to make inquiry about people's ability to repay. You have to take account of their needs and purpose and a whole bunch of other things, right? And for the last 4 or 5 years, those responsible lending standards were too lax. That came through in the Royal Commission.
Yes.
And yet, here, the Reserve Bank is saying we need to actually lift the shutters a little and let a little more loans through, never mind the risk.
Yes. So this is a point that you and I've made in previous episodes. When you've got an economy that's running on debt and GDP is inflated because of the pushing out of debt into the economy, well, the only way you're going to keep those GDP numbers up is you've got to push more and more debt out, and that's what the Reserve Bank is trying to do. But having said that, I have to say that this story didn't really surprise me this morning, because obviously we saw what the RBA governor said at the CEDA annual conference dinner. We saw what the deputy RBA governor said at the annual business economist dinner. So these meetings are very consistent with previous statements made by the RBA, but I think that this whole genre of activity and thinking by the RBA is just completely fallacious.
Yeah, and the Council of Financial Regulators, of course, put out the minutes of their meeting, the first ever meeting, right, saying precisely the same, that credit needed to expand. And of course, the Council of Financial Regulators includes APRA.
Yes.
So it's not then totally surprising that APRA also came out today with a rather interesting announcement as well.
Yes. So just to take one step back, so in April of this year, APRA announced that it was removing the cap, and that the cap on that would allow the banks to grow the amount of mortgages for property investors.
That's right.
So previously it was banks could only grow that portfolio by 10% per annum, and that cap was removed in April of this year. Well, APRA announced today that the cap in terms of interest-only loans has been removed. So previously the amount of interest-only loans being issued by the banks was about 40% of all new mortgages, and the APRA imposed a cap of 30% because I thought the too many interest-only loans was 40% was too much, and so at the moment, like going back to October of 2018, it fell all the way to 16%. So APRA's view is that the cap in both of these instances did the job. It changed the bank behavior. The quality of the loans have improved. Therefore, the cap is no longer needed. But given the time and given the atmospherics of what's happening in the property market and in the economy, it sends a very odd signal to be doing this at this stage.
And the mainstream media, of course, have been reporting this particular development as relief for home buyers, right? Interest-only mortgages will be more available, right? And they had people on the TV tonight relieved that they will be able to get their interest-only loan. So it's interesting how that's being reported in the mainstream.
Yes. Well, so I think the interesting point here is that there's been a lot of concern about those already on interest-only loans, because I think this is a point you have made throughout the year, that 2019 was going to be a critical year, and 2020, because a whole bunch of interest-only loans will have to convert to principal and interest. Well, in effect, one could assume that the removal of this cap will help not only with new customers, but the existing customers who can't meet those additional cash flow requirements to go into principal and interest. Some of them will be able to continue on an interest-only basis.
Well, except that the underwriting standards are still tighter than they were, right? So whilst they've lifted the cap, they haven't changed the standard, right?
Yes, so, but we have 6% non-compliance, and one can only suspect that the level of non-compliance in 2019 may increase.
Well, possibly, but it's just worth highlighting that there is still an 80% valuation on rental streams, not 100%. So you have to take a 20% haircut on rental streams. You didn't have to do that previously, right?
Yes.
You have to be able to pass muster on a principal and interest basis, even if it's an interest-only loan. That hasn't changed. And you have to have a plan to replay the capital amount, not just saying, well, we'll sell the property, right?
Yeah.
A concrete plan. So my point is that the underwriting standards are still tighter, right? So it'll be interesting to see to what extent that release of the cap really does change it. And some people are saying it will have a significant impact, others saying no impact. So it'll be interesting to see.
Yes. So there was a couple of responses to this. There was the property sector saying that this was going to help provide additional liquidity into the market. So the property sector is very happy. Although, you had the chief economist from UBS saying that they didn't think that this was going to help with the re-acceleration of credit growth in the economy. But just for context, so today APRA issued a letter that announced this. So we'll just go to the key paragraph of the letter. So this is the APRA letter that was issued this morning. Here's a key paragraph. In April 2018, APRA announced the removal of the supervisory benchmark on investor loan growth, reflecting the improvements that ADIs have made to lending standards. APRA is now also removing the supervisory benchmark on interest-only lending for ADIs that have provided assurances on the strength of their standards. Now, it is interesting that because this is the key point. They said they will remove the cap where assurances have been made. Well, one point from the Royal Commission is a whole host of people made assurances to the regulators, whether it's APRA or ASIC, and they're lying through their teeth. So the fact that APRA is now saying, well, if you tell us everything's okay, we're going to remove the cap. Well, surely the Royal Commission has taught people, well, no, keep the rules in place because the ethical conduct in some of these banks are not up to muster.
Yeah, unless the regulators are now going to start a much more forensic analysis of the behaviour within the banks, but there's no evidence of that. They're still taking the word of the banks effectively on trust.
Sure, and I don't think we can assume that APRA's conduct or level of rigorous analysis will improve in 2019 because they largely escaped scrutiny from the Royal Commission.
They did, didn't they? They got away nearly scot-free. It was poor old ASIC that got hit over the head by the 4x2. So,
yes,
yeah.
Indeed.
So I'll just make one other point. The ABA, the Australian Bankers Association, also came out saying, well, that will give customers even more choice for their mortgages. So they're supportive of it as well.
Yes.
But John, I guess the real question is, what's your reaction to this move? What does it really signify?
Yes. So I think a couple of points to be made. So I think the first point is that where APRA thinks that bank behaviour is going to be static. So yes, they put in the caps. Bank behaviour did improve in terms of how lending happened. Now they're saying we're going to take the caps away based on these insurances, and the banks won't go back to their old ways. I think that's a bit of a stretch assumption. I was at a function in Canberra earlier this year for the ACT Economic Society, and one of the chief economists from the Big Four banks was there, and they gave a presentation about the Australian economy. In the Q&A, I did ask a question about their views about the quantum of debt in the economy, and I said, do you think it's sustainable? Do you think it's unsustainable? And if you think it's sustainable, at what point does the debt become unsustainable? Well, interestingly enough, he didn't want to answer that question, and he didn't. But what he did say was that to keep the economy growing at a healthy clip, they will have to continue to have credit growth, going quite robustly, and that what he expected to see at some point is a sort of loosening of credit quality and credit standards. So I was surprised when he said that. Chief economist at one of the big four banks saying that that over the next sort of 12 to 18 months, credit quality and credit standards are going down. This is at the same time that the Royal Commission was on, but obviously it looks like what he was sort of saying back in I think April May, it is now sort of coming to bear with what the Reserve Bank and APRA are doing.
And it is remarkable that we know from the Royal Commission and from other sources that the lending was way too lax. There were people with loans they should never have got in the first place.
Yes.
That's why mortgage stress is so high. That's why many people are struggling with the mortgage they've got. And we've got this 190 ratio, right, of loan to income. One of the highest in the world, right?
Yes.
And yet now the regulators and the RBA want to turn the wick up again. And it's all about the credit impulse. It's all about trying to maintain the momentum in the economy by increasing the rate of credit growth.
Yes. So that's largely my interpretation, although I had a very interesting conversation with a federal parliamentarian. Now, I will say that this parliamentarian is in the government. I won't go beyond anything. I won't go beyond that. But I have sort of got a couple of sort of excerpts of this conversation because I thought it's very interesting to give the audience an insight as to what do people in Parliament really think about today's announcement.
Right.
So basically, it was a few text messages. So I basically texted, a federal member of Parliament and said, here's what I said. APRA has removed the interest-only mortgage lending cap for the banks this morning. This action, plus the RBA's desperate plea to the banks to keep pushing credit into the economy, means that the government is intent to continue to expand the debt bubble for as long as possible. So this federal parliamentarian responded to me by saying soft landing. So basically say, not that they're going to try to reflate the house prices, they're trying to put a floor under the market. And now, how do you put a floor on the market? You try to bring new buyers in at a cheaper price point, so that they can sort of stabilize the price. How do you get new demand? You've got to loosen credit because these guys don't have equity to be able to buy these new properties. So that's what they're trying to engineer. Getting more people, like the only way they can get more buyers into the market is to get these people in debt. But that's how they're trying to do this. And so the goal at the moment is to engineer a soft landing in the property market to. So rather than the 40% fall or the 80% fall that we've talked about is, Shane Oliver said 20%. So if it's in that 15 to 20% gradual, no real impacts on the real economy, that's what they're trying to engineer. Now, when the federal MP came to me and said that the intent of the government is a soft landing, I basically went to them and said, quote, impossible. The crisis does not come from falling house prices, but from unsustainable debt levels. What I meant by if they, as in the Reserve Bank, if they are focused on property prices, they are focused on the wrong metric. So this is a consistent point I continue to make to federal parliamentarians, but also to other people who I talk to, that the Armageddon doesn't come from falling house prices, it comes from when the debt becomes unserviceable. The federal parliamentarian then went on to say, supporting house prices to stop downturn precipitating debt defaults. So basically this MP is saying that if prices fall too hard too fast, that's going to spread into the real economy. It's going to obviously have a massive impact. It's a reverse wealth effect. People are going to feel obviously less confident. That's going to reduce consumption. That's going to reduce growth, and then you less employment, and then you can start to see some defaults. So basically, they're saying by having this soft landing, stabilizing the property prices, you're going to stop defaults from happening because of the potential impact on the economy. Now, that to me is a very short-term thinking, because the way they're trying to do this is that they're trying to get more people into debt, and by virtue of trying to get more people into debt to stabilize the property market, you're just creating a bigger problem that's going to come to this Armageddon that I've been talking about. So I went back to this parliamentarian and said, as in the government and the RBA and APRA, I said that that is only a short-term play in terms of this soft landing, not a long-term solution. So we had a bit of a conversation beyond that, but that is the essence, that they're trying to stabilize prices by increasing demand in the housing market. The only way you can do that is by getting more people into debt. That's why they're loosening it, but they're addressing the wrong economic problem, and the real crisis, the real risk, the real danger in the economy. It doesn't come from falling prices. It comes from unserviceable debt, and they're playing a short-term game, and no one's got a strategic vision or a strategic view about the long-term sort of challenge, issue, systemic crisis.
So, John, the question then is, why do you think there's so much focus on trying to stabilise the property market at the moment? Yes.
So. Obviously going back to the last episode, we had, I was in an MP's office 2 weeks ago in Parliament House. There are people right across the Parliament that knows that there is systemic risk in this economy, but also right around the world, and that we could face a massive financial crisis more significant than 2008. Now, there have been a number of big things that have happened in the Australian economy for the last 10 years where domestic players domestic politicians, domestic bureaucrats, they are responsible for a whole host of very poor policy settings. Not only just in terms of what the Royal Commission found in terms of what ASIC and APRA may have been faulty on, but obviously I look at the Reserve Bank, I look at Treasury, etc. So the establishment, from what I was told, was they're going to attempt to have this claim of plausible deniability. This crisis happened, it came from overseas, we couldn't see it, therefore don't blame us. So what my hypothesis is from what I see today is they are trying to stabilize the property market, but in reality, I think they're playing for time. So because if there's no international shock, and just say we have a hard landing and a lot of people go belly up in the Australian economy, well, there is no one to blame other than the people within Australia. And look at what happened 10 years ago in Ireland. Politicians lost their job, key bureaucrats, their careers were ruined, banking executives, that they all went to jail as well. So if we have a domestic crash, hard landing, and there's no one to blame other than ourselves, there's a lot of people within the establishment in this country that could lose their career, they could lose their pay, they could lose their status, etc. So what I think is really happening is they're playing for time by trying to stabilize the market for now, kick the can down the road, and then hope when this international shock comes, whether it's from China or the US or Europe, wherever, at that point, the media and the establishment will say, well, see, it wasn't us. The economy was still quite strong. We had everything under control, but it was this international force, this international issue that really sort of crashed the Australian economy. Therefore, because it was overseas, you can't blame us. So my reading of what happened today is a deliberate attempt to play time. So this play to have plausible deniability at the point of Armageddon. That they'll be able to achieve that.
So they can basically say, nothing to do with us, it's their fault overseas, right? Rather than actually taking responsibility for 10 years plus of dumb decisions here locally.
Precisely.
Scary.
Yes.
John, thank you very much.
Thank you very much.
So there you have it. John's perspective on what's really going on today. Sounds plausible to me. I'm Martin North from Digital Finance Analytics. Thanks for watching. See you next time.